Good morning. I am Brian Aronson, shareholder and audit lead in the Waterloo market, and like Brent, a member of our firm's quality control committee. I've been with the firm just over 14 years, so sorry, Brent, I wasn't around to do the 1983 IRS Form 990, but I do spend the vast majority of my time focused on our nonprofit clients. Today we're going to spend some time going over both AICPA and FASB updates. Unlike the lack of changes that Brent talked about on the 990, we have some fairly significant changes here. The first one being the Statement on Auditing Standards, the SAS, and the audit reports coming from the AICPA. And then we'll talk about two accounting standard updates that I think will have significant impact on the reporting for nonprofits. And briefly cover some areas of concern that we continue to see as organizations really understand the application guidance of revenue recognition for nonprofits. Slide, Bethany. The first one here, the SAS update, there were several new pronouncements that have a significant impact on the auditor's report. These are, for the most part, I guess there's two parts. There's significant format changes, so some geography, some things moved. You'll now see the opinion at the very beginning. We want to highlight that as opposed to it kind of being buried at the end. But there's also some significant content changes, some additional items that are included in our auditor's report that were not included before. So for those December year-end clients that we might have on the call, you've already seen these in your issued December 2021 financial statements or audit reports. For those fiscal years, the June 30 is another fiscal. You will, expect to see a change in the audit report in that. The reason why the AICPA made these changes is they determined that there continues to be an expectation gap between what the users need and expect from an audit report and what we as providers are actually doing from an audit perspective. So there's a significant additions, and it's really trying to provide transparency into the audit process, really spelling out what an audit is, what it isn't, and where some of the risks are in an audit. And again, this was effective for periods ending on or after December 15th, 2021. So what doesn't change? The types of opinions that we have in our at our disposal. We still have unmodified, which is a clean opinion, or modified, qualified, adverse, disclaimer. So the types of opinions don't change. And we still have emphasis of matter and other matter paragraphs that we had before. What is new, however, like I said before, significant reordering, the geography of where things are in that auditor's report, and rewording. There's expanded text about management and auditors' responsibilities, including we as auditors, our responsibility to maintain independence. It was titled before that we were independent auditors, but it's spelled out now in the text that we are required to maintain independence. And then both management and auditors' responsibilities for the assessment and reporting of going concern. If applicable, there continues to be a section on substantial doubt about the ability to continue as a going concern. Something that will impact most nonprofits, if when applicable. We may have a section on the client's annual report. So because that is new, it's really important that clients continue to share that annual report with us, and I'm going to get into some of the details here in a few minutes on that. And then something that could be applicable, I don't expect it, but if we are as auditors engaged to give an opinion on key audit matters, that would be an applicable section. I think this is something that is more relevant to the publicly traded and SEC side of the house. but this was a change that was brought down this year as well. As I mentioned, annual reports, most nonprofits, issue some sort of annual report, and as a result, there's a potential that inconsistent annual reports that are issued by the nonprofit, and then our financial statements, there's the potential that if those are inconsistent, they could potentially be misleading, which could lead to the undermining the credibility of the financial statements and the auditor's report. So as a result, I think if you go to the next slide, I must not have had that in there, sorry. So as a result, it's really important that nonprofits share their annual reports with us, that they communicate the timing and expected content of that annual report, so that we can determine, A, does it need to be in our audit opinion, or B, what type of procedures do we need to perform? Anytime you mention both financial statement information and the audit or auditors, that kind of triggers for us that we have some sort of additional procedures that we've got to do now. It may just be scanning them, reading them to make sure they're materially consistent with the financial statements, or depending on the timing of when they're released, it may mean that we need to include a separate section in the audit report regarding that annual report. So how to prepare, communicate with the board and others that changes are coming. So don't be surprised during that audit exit meeting or management presentation that the audit report looks different. This is brought down from the AICPA, nothing that you as a nonprofit did, really just changes there. I think all nonprofits, all entities, can work on their documentation of going concern considerations, and understanding now that it's in the report, especially, it's led to some additional discussions on what do we as management need to be doing to address going concern. And then, as I said, share prior and planned annual reports, kind of the content and expected timeline with your auditors. Next. Oh, we've got a CPE word. And I did see the attendance bumped up a little bit before I came on. I can only assume that everyone wanted this update. So CPE word, attendance. Right, the next two items I wanted to talk about this morning were the two accounting standard updates, ASUs issued by the FASB, both effective now or soon. The first is regarding in-kind contributions. This will have a significant impact on the disclosures of in-kind non-financial contributions. It doesn't affect the recognition, and I will get into some reminders there on recognition, but what it does affect is presentation and disclosures. The why here, many organizations, unfortunately, were improperly inflating revenues and expenses to mislead donors. They were doing this through inflated in-kind contributions. So this is intended to provide transparency about non-financial assets through enhancements to presentation and disclosure. And for those fiscal year end, June 30, 2022, filers, this is effective now. This will be effective for for this period. Those calendar year ends, it's coming for December 22. So what doesn't change, as I mentioned, the recognition for in-kind contributions, actually recognizing it, on the statement of activities, but the recognition for in-kind contributions, including materials, contributed services, or advertising. What is new is we do now have to present contributed non-financial assets as a separate line on the statement of financial activities, and I'll show some examples. We do need to disclose disaggregation by category of non-financial assets. So the type of asset that you received, was it services? Was it a vehicle? Was it property? Was it, food? So disaggregation by category. Disclosure of any donor restrictions that might come along with those. So I'll show you some examples on those as well. And description on the valuation techniques used. This is one of the really big ones as it relates to the why they made this change. There was a lot of different valuation techniques that were used on in-kind, and the how those were valued wasn't disclosed in the financials. So the requirement to disclose that now will hold a lot more entities accountable for the amount that they're disclosing, and then disclose the market that's used to arrive at the valuation or the fair value. As I mentioned, one of the requirements is to show gift in kind as a separate line item on the statement of activities. In the past, this may have been buried just in a contributions line, where now we're required to show it as a separate line. So this is a one example of what it might look like in a column fashion. With donor restrictions, without donor restrictions, and then you've got your gift in kind highlighted there of $67,680. And if you go to the next slide, this is just another option for how you could report. You could have a separate column just for the non-financial, so it would be very easy for your users to see. In this example, you received $67,680 of contributions and grants. Non-financial, you spent, if you will, $65,210 of those, which would mean that the difference is sitting in your inventory. Next slide. So that was the statement of activities. This is the disclosure piece. And again, these are just examples, but I think they should be relatively easy to follow. And the actual ASU has a full page of different types of examples of what the AICPA is, the FASB is intending for disclosures here. So in this case, there was food of $49,920. We disclosed how it was used. So it was used in the mobile food pantry. That's the program. We disclosed any donor restrictions. So the donor in this case said that $10,000 had to be used for hurricane response in the local community. The remainder the nonprofit was able to use as under their own discretion. And then we described the fair value technique that was used. So in this case, they used the estimated average U.S. wholesale price provided by America's Food Product Valuation Survey. So very similar to items that we've seen used. They also received clothing and supplies that were used in the adult children's program. There were no restrictions on how to use them. And they used a like-kind methodology that was available. So that's one example of a disclosure. That's called the tabular. If you go to the next slide, this is more the narrative example. They don't prescribe to us exactly how we have to disclose it, but they give us a few examples. So depending on the rest of how the rest of your financial statements flow, either one of these may be particularly preferred. But I think both examples give you the same information, just in a different format. Slide. Again, they're highlighting here that the principal market that was used. So even though in this case it was restricted to hurricane response in South America, the market that was used for the fair value was the principal market, or the the market with the greatest volume and level of activity. So wherever you can get the, like I said, defining what that is important to the reader. Slide. Just a high level on when to record. So here's some contributed services. This comes up a lot. This did not change the when to record. So contributed services, you record when one of two exists: the services create or enhance a non-financial asset, or the services require specialized skills that are provided by individuals possessing those skills and would typically need to be purchased if not provided by donation. So, you know, a lot of cases we have volunteers that are doing a lot of different things. However, they don't meet either of these criteria. If they do, then the nonprofit does need to account for those as in-kind contributions, as both revenue and expense. And it's really important for a reader to see that, because without that in-kind, that means cash would be needed to actually pay for those. And that's why these are disclosed. Next slide. Contributed goods. When to record, it's when the nonprofit has discretion in using or distributing the gifts in kind, and we've kind of assumed the risk of ownership over those items. So a little bit of a reminder there. Again, no change, but just a good reminder of when to record. And then these are some common in-kind contributions that nonprofits forget about when they're working, you know, at year end at recording. So maybe a checklist, if you will, you know, for those in the accounting department, maybe working with the development team and others within the organization, and just asking these questions. Did we receive any radio time or advertisement? What about free use of facilities or utilities, personnel costs from affiliates, any contributions for fundraisers, admin costs, collection items, or below market interest rates. So how to prepare for this? Really, nonprofits should be defining their process on identifying receipts of in-kind contributions. So making sure that we've got a solid process working across the organization, not just in the accounting department. But hey, anytime we're receiving those items that were on the previous slide, we've got a process to track those. You know, having a standard valuation process. So if we receive a car, do we know how we're going to do it? To how we're going to value it. Revisiting your gift acceptance policy. So this is a good time to determine, hey, what gifts will we accept? Which ones do we just need to politely say, hey, that's not something that we are willing to accept right now. And then maintain support for your valuation come audit period. Another CPE word. If everyone can write that down, including myself. Service. The second ASU that I want to highlight today will be coming up here shortly for most nonprofits, but the FASB issued this ASU that will have a significant impact on the financial position. Won't necessarily impact your statement of activities, but will impact your balance sheet or your statement of financial position. So what this does is it creates right of use assets and lease liabilities. The why here, lease guidance really hadn't been changed since 1976, and it is intended to, again, provide transparency on the nonprofit's non-cancelable commitments and obligations. So really highlighting, hey, we've got these non-cancelable long-term commitments that are really important for a reader of the financials to understand. This is applicable for periods beginning on or after December 15th, 2021. So really for calendar year 2022, fiscal year 23. In this, you know, the first thing we've got to really do is identify the lease. So we've got an identified asset that we can control, and then we've got the right to control it. So the first thing is ensuring, do we have a lease? And there's specific definitions on that. If you go to the next slide. So an identified asset is we've got the lease, we've got the copier, the scanner, the printer, we've got the third floor of the office. It's not. It's got to be a distinct asset. So, for example, if you have the right to use a warehouse, but you don't necessarily control where those assets are stored, that wouldn't necessarily be a lease. We can go to the next slide here. Again, we've got the right to control the lease, or right to control the asset. Again, some definitions here. A lot of times we do run into people think they have a lease, and then turns out we don't actually have a lease. So there's some definitions here that will be included in your slide deck that is sent out following. We can go to the next. A lot of discussion on this has to do with short-term leases. So short-term leases are defined as leases that at commencement date have a term of 12 months or less and do not include an option to purchase the underlying asset, that the lessee and it should say and that the lessee is reasonably certain to exercise. This policy election must be disclosed in the financial statements. The existence of lease extensions and the likelihood of extending the arrangements must be considered in determining the term. So you may have a written lease that says it's 1 year, but you've got the option to renew it year to year or month to month after that. And for example, say you put $100,000 of leasehold improvements into that property, you're most likely not going to walk away after 12 months. And that right to extend the lease kind of eliminates the short-term option. So just having your written lease term of 12 months doesn't necessarily get you out of implementing this. If there's other facts and circumstances that would be a reasonable certainty to exercise extension. So there's definitely a lot of discussion around how to structure leases, but this is one of the caveats. There's really only two types of leases now. There's finance leases and operating leases. So depending on, the capital lease is gone. That's kind of replaced with finance lease. And then we've got operating leases. So as you can see, both end up on your balance sheet as right of use assets and lease liabilities. So it doesn't matter anymore if it's finance or operating, it's all on the balance sheet. There is some differences in the income statement or statement of activities reporting, depending on if you meet the criteria for financing lease, the old capital lease criteria, or if it's an operating lease. The one is straight line, really just rent expense, and the financing lease, there's an interest component to it. Also affects your statement of cash flows. Slide. Here is some, I thought this was a good example of some acceptable and unacceptable presentations as far as what your balance sheet might look like. So the left and the middle are acceptable, the one on the right is not. So we will have to put it as a separate line item on your statement of financial position or balance sheet. The right of use assets, the right of use operating leases. We can combine finance leases with property, plant, and equipment, but we have to, if we do, we have to have a separate disclosure of how much is included in there. So depending on the flow of your financial statements already, either the left or the middle is acceptable. We can't combine all of our right of use assets together. We won't combine these right of use assets with property and equipment in the instances of operating leases. So it most likely for most nonprofits will add at a minimum 2 lines to your balance sheet. It will add a right of use asset and a lease liability. But depending on the mix of operating and finance, the presentation could vary. So how to prepare, similar to in-kind, define your processes to identify all of the leases. The accounting team may need to work with others. Hey, where do we have space? What are we using? Define the key controls of recording your leases, including management's determination of renewal options, and as the guidance talks about, the reasonable certainty to exercise those renewals. Revisit current leases and upcoming renewals. Understand the impact this will have on the financial position. Start having discussions with users of the financials that may be looking at different ratios of assets to liabilities or liabilities to net assets type thing, and understand that this will change that. And then really just to get organized with your lease documentation, be proactive in implementing prior to fiscal year end. And we've got another word. It is webinar. The last piece that I wanted to highlight isn't necessarily anything new. However, it is something that we continue to see entities struggle with, and it's really just the proper revenue recognition treatment with nonprofits, because it does get quite technical and quite complicated very fast. Revenue recognition is obviously the most important aspect in general to the nonprofits' financial statements, and can really impact what the users see as far as results. So if we go to the next slide, we've put together really 5 steps, without getting too technical, 5 steps that you should identify in all transactions. So many nonprofits have various revenue streams. So the first thing is to identify, is this transaction or revenue stream, is it an exchange or is it a contribution? So exchange contribution, the person paying you is also receiving a benefit. So I call these fee for service. John Smith is paying you, John Smith is getting service in return. Where a contribution, there is no return for the donor other than the donative intent. They're not necessarily receiving a service. So exchange transactions will follow accounting standard 606, contracts with customers, while contributions follow 958, 605. So what that means is exchange transactions, we've got to perform before we can record the revenue. We've got to do something. In a contribution, we've got to go to step 3 there and determine if the contribution is conditional or unconditional. In many cases, we have unconditional promises to give. So in those cases, we record the revenue right now, regardless of if the donor says that it's for a future period, or it's for a future program, or it's as long as there's not a measurable barrier and a right of return, we record it now, which can disrupt nonprofit financials as far as timing up your revenue with your expenses. But unfortunately, this is what the rules tell us to do. When we've got unconditional promises to give, we record them immediately. So then the last step there is, okay, we've got these unconditional promises, we've recorded the revenue. The last step is it restricted? So there's a difference between conditional, unconditional, and restricted, unrestricted. The first step is determining if it's conditional. The next step is determining, is there restrictions? Is the donor telling us they're not going to pay us for 5 years, or they're not going to, or that they'll only fund, this certain program? We may still recognize the revenue, but it's going to show up in our net assets with donor restrictions. So I think that's the high level that I wanted to cover on revenue recognition. Do we have any questions, Bethany?
Yeah, we have a couple here, Brian. The first one, what is the threshold for being required to publish an annual report? For example, 80% of our budget is funded by the state and federal grants.
That's a great question. To my knowledge, there is no threshold for publishing an annual report. There may be specific funders or states that require it. Here in Iowa, there's no requirement that I'm aware of. But it's most nonprofits will publish it as a marketing opportunity, showcase the programs we've accomplished, the things we've done, the people we've served. But then at the back end, a lot of times we see the financial statements and maybe our logo that these were audited by Burke and KDB. But to my knowledge, there is no threshold for publishing an annual report.
Great, thank you. The next one here, kind of also in lieu of the thresholds, we received some small in-kind donations. Is there a threshold for when we need to record those? Or what do we need to keep track of kind of as it relates to every small donation?
Yep, and with all accounting standards, we deal with materiality. So I think for the nonprofits, do you need to record every single in-kind donation? The answer is no. We need to you probably need to set some thresholds, some policies depending on the size of your organization. Work with your auditor to determine, hey, what's material to you, and then the nonprofit can determine what's material to them. By material, I mean significant to the financial statements themselves. So every time somebody drops off a $5 shirt, do we need to record it? No, but if somebody's going to give us free space for our fundraiser, or if we're getting cars donated or buildings or land, obviously those become pretty significant pretty fast. So setting some thresholds, understanding what's material to your financial statements will go a long way in determining what processes you need to put in place to track these throughout the year.